Good day, investors. I'm Mike Smith, CFO of PSG Konsult, and pleased to have the opportunity to share with you our latest annual financial results for the year ended 28th of February 2023. I'm going to run through our overall financial results. I then touch on our divisional performance, some of our focus areas, some return and trading stats, and finally give some concluding remarks. If we look at the PSG Konsult group structure, it remains unchanged, other than the fact that PSG Group unbundled their 60.5% shareholding in PSG Konsult on the 12th of September 2022. This unbundling, as previously advised, had no impact on our business model, operations, or financial position. PSG remains an advice-led business with a broad geographic footprint throughout South Africa and Namibia. This enables us to service our clients where they reside. We have 947 advisors operating from 266 offices. 62% of our advisor force are wealth advisors, and the remaining 38 are insurer advisors. If we look at some of our business characteristics, number one, we're equity market dependent. A substantial portion of the fees we earn are linked to the value of our client assets we manage and administer. Secondly, our administrative and platform businesses are people and system dependent. We continue to attract entrepreneurial people with a can-do attitude to the firm. We are proud of the progress we've made in growing our own talent, with 141 newly qualified graduates, 96% of whom are ACI candidates, having joined the firm during the past financial year. PSG Konsult continues to generate strong cash flows, with our cash earnings actually exceeding our reported earnings due to certain non-cash items, including a 68.9 million of intangible asset amortization costs and 51.3 million of share option costs. This gives us various options to optimize our capital structure and risk-adjusted returns for the benefit of shareholders. We have 21 regulatory licenses, 17 in South Africa and 4 in foreign jurisdictions. PSG Konsult is also licensed as a controlling company as an insurance group, which means that because of all our regulatory licenses, we are vulnerable to regulatory change, but to manage that risk, we play a very proactive role in ensuring that we are at the forefront and aware of regulatory changes so we can incorporate that into our business. I'm then going to take you through some of the macroeconomic indicators, which gives you a bit of a backdrop to be able to better understand our results. Number one, global interest rates have trended upwards as the central bankers have aimed at trying to normalize inflation rates. This has led to an increase in currency and market volatility. We saw a 19% decline in the closing Rand-US dollar exchange rate versus only a 13% decline if we use the average exchange rates for the two financial years. The current financial year, the average exchange rate was 16.71, versus in the previous financial year it was 14.85, the Rand-US dollar exchange rate. The devaluation of the Rand results in the S&P 500 delivering an 8% Rand return, while the JSE index only increased by 2% this year compared to 15% in the previous financial year. If we look at now our results, I'm going to start at the bottom section of the table. We achieved a 13% growth in assets under management, a 9% growth in premiums, and an overall 8% growth in our top-line revenue. The top-line revenue growth we achieved once again demonstrates our ability to generate new business despite a tough trading environment. The firm remains confident about its long-term growth prospects, and therefore we continue to invest in technology and people. Fixed remuneration costs grew by 10%. The reduction in our weighted average number of shares is due to the repurchase and cancellation of shares as part of our capital optimization. The net result of above is that we delivered a 5% increase in recurring headline earnings per share and a return on equity of 22.7%. If we then move across to the divisional performance, first of all, the wealth division generated earnings of 569 million, which is 60% of our overall profits. Asset management delivered earnings of 220 million, which is 23% of our overall earnings. And the insured division delivered earnings of 160 million, which is 17% of our total earnings. So PSG Wealth achieved growth of 11%. Our core income increased by 9%, consisting of continued increase in management and other recurring fees, while transactional brokerage revenue decreased marginally due to slightly lower trading activity this financial year. PSG Insure, they achieved a 9% increase in gross written premium. However, their earnings were negatively impacted by the impact of the KZN floods, which was classified as a catastrophe event. PSG Asset Management, their results were impacted by lower performance fees. However, management fees increased by 11%. What we are proud of, if you look at the compound annual growth rate that each of the divisions have achieved, the Wealth Division, 14% compound annual growth over the past 5 years, Asset Management, 7% over the past 5 years, and Insure, our best performing, with a 17% growth over the past 5 years and a 13% overall. If we then move across to our financial trends, so we continue to manage and evaluate the firm's performance against an unchanged set of metrics. Our 10-year track record highlights the sequential improvement in our key metrics. If I just flag a couple of key metrics over the past 10 years, number one, our assets under management, the first line, 17% growth, core revenue, 15%, recurring headline earnings per share, 17%, and our dividends per share are up by 13% over the past 10 years, as well as you see a substantial improvement in our credit rating and SCR ratio. Aligned with our aim to optimize our capital structure and risk-adjusted return for shareholders, during the current financial year, we repurchased and cancelled 35.7 million shares at a cost of 415.9 million. In addition, the board decided to increase the upper limit of the group's dividend policy payout ratio to 60%. Previously, this was 50% of our recurring headline earnings, excluding intangible asset amortization. The board declared a final gross dividend of 25 cents per share, represent a 13% increase for the full year, which means that shareholders will receive 36 cents per share for this financial year, reflecting our sound financial position and confidence in our growth prospects. The sequential growth in our earnings and dividends per share for the past decade is testimony to a great firm aimed at carefully managing risk and delivering strong shareholder returns. We'll move across to our divisional performance. First to our Wealth Division. Our Wealth Advisors managed client assets increased to 305.5 billion, which included 13.3 billion of positive net inflows during the year. Our weighted average value of managed client assets was 279.1 billion, which was up 8% from the prior year, particularly because one saw the market rise in the last 2 months of the current financial year. PSG Wealth was recognised as the Wealth Manager of the Year, large institutions at the Intellidex 2022 Wealth Manager of the Year Award for the 4th consecutive year. The division also won the Young Professional, Lump Sum Investee and Retiree Archetype categories at the Intellidex 2022 Wealth Manager of the Year Awards. If we move across to our net flows, during the past 5 years, the wealth business has secured 69.8 billion of managed client asset net flows. Our sustained investment in our digital capabilities aimed at enhancing our overall client experience has enabled our high quality and caliber advisors to maintain excellent client relationships and service levels, which is one of our key drivers of success. PSG Wealth continues to advise clients to focus on their long-term goals and to maintain well-diversified portfolios, especially during these volatile and uncertain times. On our advisor side, our wealth advisor force remained relatively stable. We had a net increase of 6 advisors. During the past year, 41 new advisors joined us and 35 left. Move across to PSG Asset Management. PSG Asset Management grew client assets under management by 16% to 48.6 billion due to a combination of the excellent performance returns we generated for clients, plus our positive net client inflows. Our weighted average assets under management was up 13% from the prior year at 43.4 billion, and the total assets administered by the division increased by 14% to 197.6 billion, supported by the 7.7 billion of positive multi-manager net inflows. If we look at asset management, the inflows that we secured during the year amounted to 1.1 billion. That's the last two bar charts. If we look at PSG Asset Management, they continue to engage with clients on the merits of its 3M investment philosophy and the importance of staying in the market throughout the investment cycle. The division's long-term investment track record continues to improve, with most funds performing in the top quartile over a 3-year period. PSG Asset Management's strong fund performance across the entire range was also recognized at the most recent Raging Bull Awards. The division, in fact, received 6 awards, including the coveted South African Manager of the Year award. This is testimony to a team's ability to manage the full spectrum of multi-asset funds. Insure. PSG Insure achieved premium income growth of 9% during the current financial year. The division continues to focus on profitable growth with an emphasis on the commercial lines type of business, which requires advisor expertise. Western received the Product Supply of the Year Non-Life Commercial Award at the Financial Intermediary Advisory Award session that took place in September 2022. On the Insure side, our Insure advisor force decreased by 3%, but we had 20 new joiners during the year and 31 that left. Slight decrease in Insure advisors due to the amalgamation and consolidation of certain PSG Insure advisor offices. If we look at PSG Insure, their recurring headline earnings were negatively impacted by the KZN floods, which was classified as a catastrophe event. The impact, as indicated in the table, was a 10.4 million rand. But despite this, Western achieved a net underwriting margin for the full financial year of 13% this year versus 18.5% in the prior year. This was achieved due to the quality of our underwriting practices and our comprehensive reinsurance programs. We now move on to some of the top-line focus. So the group still has relatively small market shares and therefore remains confident about our strategy and prospects for growth. The firm generates an overall top-line revenue growth of 8%, with asset management growth being adversely impacted by lower performance fees this financial year. We continue to monitor and evaluate our overall business performance by focusing on 3 core metrics: recurring revenues, profit margins, unit of risk relative to return on equity. Our operating margins were marginally impacted by the KZN floods, plus our continued investment in technology and people. As indicated earlier, our technology spend was up 19% and our people's fixed remuneration costs was up 10%. Performance fees contributed 6.5% of headline earnings this financial year versus 10.6% in the previous financial year. Group also has no interest-bearing debt, which adds to the group's strong financial position and excellent liquidity. Going to touch on some return and trading stats now. The above table depicts the investment returns that a shareholder would have earned during the past 18 years where they had reinvested their dividends relative to the JSE All Share Total Return Index, both in rands and US dollar terms. I think it's a table that we're proud of, that we've been able to deliver superior returns for shareholders both in rands and dollars over a long sustained period of time. During the 2023 financial year, shareholders achieved a 15.7% return on equity net of inflation. And you can see in that graph, we've delivered good positive return on equity net of inflation for each of those periods for shareholders. Moving on to some of the trading stats for PSG. PSG Konsult liquidity has increased substantially post the unbundling by PSG Group on the 12th of September. At present, 51% of our shares are currently held by institutional shareholders, and the number of PSG Konsult shareholders has increased from 5,500 to over 18,500 shareholders. We believe that this rise in shareholders will continue to elevate the profile of the business. Finally, some concluding remarks that we believe underpin our expectation for future success. Number one, our formidable advisor network in South Africa with a broad geographic footprint that we continue to expand. Our strong governance structures we have in place. Our clear growth opportunities for the business, coupled with us having relatively small market shares. Our history of delivering superior shareholder return, and our focus on optimizing our risk-adjusted returns per share by being very restrictive on the issuance of new shares. And in fact, during the current year, we've actually bought back shares to optimize our risk-adjusted returns for shareholders. Thank you, everyone. I appreciate you listening to me.